Lecture 16 of Financial Reporting, IAS 37. So in IAS 37, we are going to go through provision, contingent liability, and contingent asset. There are three things dealing with IAS 37. And IAS 37 is also a very frequently tested standard. It almost comes in almost all the paper. Okay, all the sitting it comes, both for FR as well as SBR. So now in here, under IS 37, accounting for uncertainty, background of IS 37, objective of the standard, scope of the standard, provision and contingencies. Then under recognition issue, we are going to go through the criteria, present obligation, probable transfer, reliable estimate, and the measurement principle, approach to measurement, time value of money, recognizing a provision, subsequent accounting, reimbursement, disclosure provision, and under contingent liability and asset, contingent liability and asset, and summarize. Then application to specific circumstances. Now in your exam, you might be given one of the circumstances. It could be a future operating loss, it could be an onerous contract, it could be restructuring, it could be decommissioning and restoration cost, self-insurance, or repairs and refurbishment. You have to know whether you have to recognize provision in each of this case or not. And finally, we are going to conclude this with which part of the syllabus we have covered by this lecture, summarize the entire lecture, and whether there are any technical articles that you have to read for provision and contingent assets and liability. Now, so this is what we have gone through. IS 37, the issues, measurement and accounting, and applying it to a specific circumstance, and the contingencies. Now, why we have to account for uncertainty? Because remember, our accounting, when we prepare the financial statement, we prepare the financial statements based on some concept. One of the concept was prudence concept. Prudence concept says that you do not overstate your assets or income, nor you understate liability and expense. Okay, therefore based on that concept, we are going to account for uncertainty. Okay, one example is legal case where you are sued for the damages by another party. So whether the monetary damages will be paid, or if so, how much, is very uncertain until the legal case has been settled. But of course it will be settled. It is not something that is so uncertain, so remote that it will never happen. Of course it will happen, but today you are uncertain. It will be something that have to be settled tomorrow. Therefore we recognize provision. IAS 37 deals with this uncertainties. Even though outcomes are uncertain, still it will result in an entity receiving an income. So IAS 37 reflects the concept of prudence by concentrating on situations in which entity has to make a payment. It could be for the entity receiving the payment also. Due to some circumstances, you might receive a payment, but we do not recognize the receiving part. We are more towards payment part, where you have to pay. Okay. So we are providing a provision for liabilities. This is what IAS 37 is dealing with. Now, what is the meaning of provision? It is a liability of uncertain timing or amount. See, all this time, all the standards that we have done until now, we have been focusing on the asset part. Tangible asset, intangible asset, non-current PPE, investment property, all these things we have been talking about. What? Non-current asset. Now we are moving towards the liability part. You understand? So provision is one such thing. It's a liability of uncertain timing or amount. Next, liability. We all know from the definition of conceptual framework, liability is a present obligation that arises from past event that will result in an outflow of your economic resource. Now, before IAS 37 was issued, see, this background you don't have to know. It is only for your understanding how provision came into the picture. That is only for that. It will not be asked in your exam. So before IAS 37 was issued in 1998, there were no international accounting standard that governs the definition, recognition, measurement, or presentation of provision. So provisions, what do? You debit the expense account and you credit the provision in the statement of financial position, because there were lack of guidance in this area. Provisions could be made, or you will not make it, or unmade to suit the management's need that are based largely on intent. It is up to you. Either you recognize the provision or you do not recognize the provision. Some entities, so because of this, there's a manipulation that is happening. Some entities are creating provisions in the good year when their profits are higher than expected. Later, they will reverse this provision where they will credit the statement of profit and loss. And in the later years, when the results are less favorable, in order to smooth the profit, they will not recognize the provision. So this big bath or rainy day, we say, provisions could be used for any purpose and were often made for one purpose but then used for another. You see, we have been manipulating this provision. Therefore, IAS 37 came as a result to reduce the ability of entities to manipulate their result through recognizing and releasing provision like this. Now you can't do that. How can we use the provision to smooth profit? Let's say there are two companies, both company A and B. They are a comparable company. If you see here, let's see the result for 3 years from 1996 to 1998. Here he has 2,500, then profit increased to 3,200, then profit increased to 3,700. Coming to company B, he has 6,500, then it reduced in 1997. The reduction is huge and then again it increased. Okay, so now if you see there's a higher profit in 1998 in company B, it looks very attractive, this 7,500. But a risk averse investor would be influenced by the possible repetition of performance in 1997. If you're a risk averse investor, they will not only see this but they will see this also, that profit has declined very rapidly in 1997. But if you see company A, there was a trend of rising profit. So it is giving an impression of high quality earnings which support a higher share price. Suppose that instead of publishing the result above, now company B decided in 1996 to restructure their provision and provide for potential cost of 3 million. Okay, so in 1997 they decided that restructure was no longer necessary. Now let's see what's the impact. This is what we say smoothing of the profit. So originally it was 6,500. Now there was a cost, so you are going to recognize a provision of 3 million in 1996. So we are going to deduct that provision. Now your result is 3,500. You are going to reverse the provision in 1997. So you add back 3,000 to this. It becomes 4,100. 1998 there is no impact. So what's happening here now? From 3,500 it is increasing to 4,100. Again it is increasing. What are you doing? So here company B is showing the investor that the profits are steadily increasing. Whereas in reality you see here it's not. Why this profit is increasing? Because of your recognition of provision like this. First you are making the provision when you're having a high profit. Then you are reversing the provision when your profit went down. You see? So like this you are smoothing your profit. This is not correct way of doing it. It's not showing the relevant result. So the objectives of IAS 37 is to ensure appropriate recognition, criteria and measurement bases are applied to provision, contingent liability, contingent asset. Sufficient information is disclosed in the notes to the financial statements for each of the above items. Now, scope of IAS 37. IAS 37 addresses all the provisions which are liabilities. It does not address amount that can reduce an asset balance, such as loss allowance for receivable, accumulated depreciation or inventory write-down. Even they are one kind of provision only, but we do not deal with them. Now, provisions and contingencies. Although IAS 37 focuses on provision, it also addresses contingent liability and contingent asset. So, they also reflect uncertainty. This also reflects uncertainty, but do not result in the recognition of amount. So, we do not recognize it in the statement of financial position. Rather, we disclose it. We'll see in section 4. More on that. Now, recognition criteria, very important. A provision will be recognized if you are meeting the certain condition. These conditions are number 1. There should be an obligation. That obligation could be present also, could be constructive also, which result from the past event. Okay, obligation to transfer economic resource. Next, there should be a probability that your outflow of economic resource is required to settle the obligation, and estimate of the obligation has to be made. If these conditions are not met, provision will not be recognized. Simple. Each of this recognition criteria we are going to discuss in more detail. That is present or constructive obligation, okay, probability of outflow and reliable estimate. First, present obligation. What is present obligation? Present obligation exists when an entity has no realistic alternative but to transfer economic resource because of the past event. That means because of some obligating event, you can't ignore it, you can't avoid this payment, you have to make the payment. It's like you are taking a loan. Now you can't say you are not going to pay the interest. You don't have that option. So a present obligation can be of two types, legal or constructive. Both of them you have to recognize provision. It is not necessary to know the identity of the person to whom the obligation is owed for. Okay? To say that there is a present obligation, you should not know the identity of the person to whom you owe. Now, obligating event. An event which can create a legal as well as constructive obligation. Okay? There is no real alternative to settle the obligation. Legal obligation. An obligation which derives because of law. Maybe due to contract you have an obligation, or legislation, or other operation of law. Mostly contract. If you are having any kind of contract to do it, it's a legal obligation. Next is constructive obligation. This obligation is derived from the entity's actions where result of the past practice. Maybe in the past you used to do that. So because of the past, it is understood that now also there is an obligation. It's a published policies. Okay? That entity will take on certain responsibility. And as a result, there is a valid expectation that will be created to the other party. Now, obligation has to be present. Just the intention to undertake future expenditure will not give rise to an obligation. You saying that you want to expend something, it is your intention, your choice, not an obligation. Provision cannot be made for general business risk or expected operating losses because they are not result of the past event. Okay? If management has any discretion to avoid the expenditure, then there is no present obligation. If you can avoid that expenditure, then it's not an obligation. You can't under any circumstance avoid the expenditure. Then it's known as present obligation. For example, a board decision alone does not create a present obligation because the board could reverse the decision also. Okay? If in rare cases it is not clear whether there is a present obligation, a past event should be deemed to give rise to a present obligation when it is more likely than not that a present obligation exists at the reporting date. This is a matter of judgment that you have to take, taking account of all the available evidence, including the opinion of experts. But this situation is very rare. They will not ask you in the exam. Mostly they will give you clear cut, obligation exists or not. Okay, now let us go through example 2 to understand this better. So let's go through the scenario where it's about a corporate event has been, following a corporate event, 10 guests became ill due to food poisoning, sold by the product Tintin. So now there are some legal proceedings seeking damage from Tintin. Up to the date of approval of the financial statement, company's lawyer advised it's probable Tintin will not be found liable. So when you're preparing the financial statement, lawyer advised that because of the development in the case, it is probable now that they will be found liable. So tell me at 31st December 2006, you have to recognize the provision or not. Before coming to the provision, you have to answer two questions. First question, present obligation as the result of past event, whether there is a present obligation. Yes, there is. One might say, no, there is not. Accordingly, you will give your conclusion. If there is a present obligation, it will be a provision. If it's not a present obligation, no provision. Like that, you have to give the conclusion. Okay. So in this case, let's see what's the answer. Even though there's a past event, what was the past event? You have sold the product. But based on the evidence, when the financial statements were approved, there was no obligation. Because of this, Tintin will not be found liable. So because of that, Tintin will not recognize the provision also. That's the conclusion. Okay. Now, what about 31st December 2000? That is about 31st December 2006. But 31st December 2007, situation changed. Now, based on the evidence, they are saying they can be found liable. So, present obligation exists. They have no choice but to settle the damage that is decided by the court. Then, second question, because there is a present obligation, remember all three things you have to meet for provision to be recognized. Whether there is an outflow of resource, yes, probability is there based on the opinion of legal experts. Where level estimate, yes, it is estimated by the legal expert. So conclusion is provision has to be recognized. This is at a different date. Now, example 3. That was about the legal obligation. Okay, this was an example of legal obligating event. Now we are coming to constructive obligation. You have to understand both legal and constructive obligation, by the way. So, an entity in the oil industry causes contamination and operates in a country with no environmental legislation. Now, entity has published environmental policy to clean up the contamination. Entity has a record of honoring this policy. You see, record in the past they used to do. So, there is an obligating event. Obligating event is there's a contamination of the land. Now, you have to clean it up. Entity used to do this in the past, so it has created some valid expectation that they will clean up the contamination. So, outflow of resource, yes, based on the past practice. So conclusion is provision will be recognized for the best estimate of the cost of cleanup. Now, example 4, future investment. The CSO, sustainability officer of a manufacturing company, has announced that they are going to invest in the new manufacturing technology to reduce their greenhouse gas emission. Expected cost is 1.2 million. See, they have just announced, but it is not an obligating event because announcement alone will not create an obligation. So obligation will not be created until the new technology is purchased and it owes the supplier. So in this case, company can reverse its decision to invest also. They can change their mind anytime. So no provision will be recognized. Now, remember out of the definition, first definition was what? Present obligation. Second was probable transfer. Let's expand that more. An outflow of resource is considered probable if the event is more likely than not to happen. That means event is more likely to happen. Okay, then it is probable. Practically, probable means likelihood is more than 50%. Now, let us see some examples of probability. So, regarding provision for warranties. During 2007, a manufacturer is giving a warranty at the time of sale to all customers who is buying model Z washing machine. So, under the terms of warranty, the manufacturer who is undertaking to make the goods by a repair or replacement manufacture defects which become apparent within 3 years from the date of sale. So based on the past experience, it is probable that the warranty claims are relating to 2% of the machines sold. Now, first question, present obligation. So sale of the product with a warranty is a past event that gives rise to the legal contractual obligation of flow of resource. It is not probable that a single washing machine will need repairing, but it is probable that some repairs will be required regarding the washing machine. Therefore, there is a probability of outflow of resource. So conclusion is you have to make the provision. Okay. Now, reliable estimate, the third part of the definition. First, there was a present obligation. Second, probability of outflow of resource. Now, reliable estimate. A reliable estimate can always be made when an entity can determine a reasonable range of possible outcomes. Only in extremely rare cases, it will be impossible to estimate an obligation that is sufficiently reliable to recognize a provision. Disclosure of the obligation would then be necessary. Where you can't find a reliable estimate, you can't recognize a provision, but you can disclose the obligation. Where no reliable estimate can be made, you can't recognize a liability, but you have to disclose a contingent liability in that case. Determining a reliable estimate is discussed in the next section. Now, coming to the measurement principle. Provision, you have to measure at the best estimate at the reporting date of the expenditure that is required to settle the obligation. Best estimate is often expressed as the amount that an entity would rationally pay, the amount that would be spent to settle the obligation immediately or pay to a third party to assume it. This is determined by the management's judgment, supplemented by experience of similar transactions and expert evidence. So you need one of this. Now, best estimate will involve expected value calculation. When you are taking from a large population. For example, determining the amount of warranty provision, you have to look at the population for this case to get an expected value. Or if it's a single obligation, you will look at the most likely outcome of that occurring. Okay, so most likely outcome is the payment of 400,000, but other possible outcomes are 350 and 300. So in this case, provision may be measured at less than 400,000. Why? Because you see, with the most likely outcome, you have to see the other possible outcomes also. You have to consider. So other possible outcomes are less than most likely outcome, that is 400,000. Other possible are 350 to 300. So you can be very sure that provision will be less than 400,000. In the exam question that requires a single obligation to be measured numerically, you should assume the measurement is at the single most likely outcome and it is unaffected by other possible outcomes. That means in your exam, you have to use the most likely outcome. So in this case, in the example above, your provision will be 400,000. Now, example 6, estimating the warranty claims. See, provision is an area where you can be asked discussion questions as well as numerical questions also. So you should be able to calculate. Okay, now, so it's about based on their past experience. Okay, 75% of the goods will be sold with no defect, 20% sold with minor defect, 5% sold with major defect. Okay, and the amount they have given. If it's minor defect, repair cost is 100,000. If it's major defect, repair cost is 400,000. They have not given any cost with no defect. So that's why when you find the expected value, see, you are supposed to calculate the amount to be provided in the financial statement regarding warranty claims. So first 75%, since you are not given any figure, will be into 0. Then 20% into 100,000, because this is the amount that will cost with minor defect, and with major defect is 400. Therefore 5% into 400. This is how you find the expected value. You should be able to find the expected value, where you will multiply the probability of it occurring, in this case percentage, multiply with the cost. Add them together, that's your expected value. In this case, provision is 40,000. Provision for warranty. Now, moving to activity 1. It's about Ray receiving a legal advice. Most likely outcome is that they are going to lose the case and they have to pay 1 million. There's a 80% chance of this happening, 10% of them having to pay 1.2 and 10% of chance paying nothing. So when you're having the best estimate, you have to add up all. Okay. So in this case, 10% into nothing, that's why 10% into 0. 80% you have to pay 1 million and 10% 1.2. Add them together, it is 0.92. Right? The expected value. So the expected value, this is not the best estimate as it is not a possible outcome. See, this you can't use in this case. From question to question, therefore it differs. Why it is not the best estimate? Because it is not likely to happen. Either you have to pay 1.2, either 1 million or nothing. Out of this 3 only you will get 1. So this is 0.92, it's none of the 3. So it's not even a possible outcome. So this you can't use as a best estimate, this expected value. Therefore, you have an 80% chance of paying 1 million. So the most likely outcome is 1 million. And if you give 1.2 million, which is the worst case scenario, where you have to pay the highest amount, it is you are overly prudent. And only 10% likelihood of this occurring. That means only 10% of you having the chance of paying 1.2. So in this case, you will recognize the provision to 1 million. Okay. Now, example 2, expected value. Ray is giving a 1-year warranty on all goods sold during the year. Past experience shows 85% no repair, 10% need minor repair, 5% major repair. And the cost is 100,000 for minor, for major is 1 million. Okay. So now 10% major repair, minor 100 and 5% major. So if you see, it's 10,000 and 50,000. If you add them together, it is 60,000. So the best estimate of the provision of all likely repair is 60,000. So this is something which is fine. Why? It falls in the range also between 100 and 1 million. Sorry, it is In this case it is accepted because they did not give you that these are the three figures. They are just giving the percentage. Okay. So the best estimate of the warranty provision is 60,000. Now, time value of money. Where the time value of money is material, you have to discount the provision. Discount rate that you have to use to find the present value will be the pre-tax rate. Okay. When there's an objective evidence that future event such as change in legislation will occur, this event will be reflected in the measurement of your provision. But gain from unexpected disposal of assets are not included in the measurement. Provision is measured before tax. Okay, always remember that. Not never after tax, always before tax. Now, finally, we are coming to recognizing a provision. A provision is recognized either as a current or non-current liability in your statement of financial position. Debit entry to recognize a provision is usually made to the relevant category in your statement of profit and loss. But in some cases, it could be recognized as a part of the cost of asset. For example, property, plant and equipment. Lecture 7. Right of use asset. Lecture 14. Decommissioning provision are recognized in the cost of an asset. This will be discussed in section 5.4 when we go for specific issues. Okay. Now, let us see example 7, legal claim. Now we have to know the journal entries also. All this while we have been doing the measurement. So you have to explain whether a provision should be made, and if so, prepare the journal entry. So it's about an ex-employee initiating a proceeding against unfair dismissal. Now the damage claim is 150,000 and their legal advisor have said that there's a very strong case and 75% probability that they will win the full amount of the damage, 25% of not winning. So in this case, provision should be made because A, B, C. A, present legal obligation is there. First, it is present and it's legal or constructive? Legal, because there is a contract. You have an employee contract and you have been dismissed unfairly. So present legal obligation because of past event. What was the past event? You were dismissed as an employee. Probability of outflow is also there because of paying the damages, which is 75%. And also outflow can be measured reliably, which is 150,000. All three criteria met, provision has to be recognized. Now comes the debit journal entry. So because you have to debit it in the P&L, you have to debit it in the expense category, which comes in the operating category according to IFRS 18. Earlier this was not there when it was IAS 1. Okay. So debit general and admin expense. Provision will come under general and admin expense, and credit provision for legal expenses. This will go as a liability in the statement of financial position, and this will go in the statement of profit and loss as an expense, 150,000. Now, subsequent accounting. After you initially recognize a provision can be decreased, increased or decreased, or it could be reversed also. Cost incurred that relate to a matter giving rise to provision are charged against the provision, reducing the carrying amount of the provision. Then, when a provision is discounted, okay, it reflects the time value of money. So the carrying amount is increased in each period to reflect this passage of time. This will be recognized as an interest expense in your profit and loss. Okay. At each reporting date, the provision has to be reviewed and adjusted to reflect the current best estimate of the expenditure. Remember, provision is an estimate. Okay. So every year end reporting date, you have to do the estimate. The provision can increase or decrease because of your change in estimate. Now, if the recognition conditions are no longer met because there is no outflow of economic resource, the provision has to be reversed. Earlier you recognized provision because there were conditions. Recognition, you have met the recognition criteria. When you are no longer meeting the recognition criteria, you have to reverse the provision that you have recognized earlier. Okay. Now, example 8. So this is a question. Let's see. An entity becomes subject to an obligating event. They have given you the discount factor 8% and the expenditure is 10 million in 10 years time. So this is how you discount. You take the 10 million and this is how you discount. I'm sure you know how to discount. If you do not know how to discount, make sure that you do calculations on discounting present value. Okay. So it will be 1 plus 0.08 because it's 8%. When you're taking 8% in decimal, it is 0.08 to the power 10 because it is to the number of years you are taking. Suppose this for in 5 years time, then it would be to the power 5. Okay, so this will give you what has to be here in the power. Okay, if it's in 10 years time, it will be to the power 10. If it's in 2 years time, it's to the power 2, like that. Then this is the amount you will be getting. And the amount that you get has to be less than 10 million because this is the future value. You have to find the present value. You have to find the value of the 10 million today. Today it will be much less. So it's 4.6 million something. Now, with the initial measurement, you have to know the journal entry also. Where to debit, where to credit. Often students make mistakes here in the provision. They don't know the debit credit. Credit, okay, they know the provision, but the debit side is the issue. So you will debit it in P&L because it's an expense. Okay, and you will credit in the provision. Your provision will increase because of this amount and you have to debit it. It is an interest expense. Okay, now that is initial 1st Jan 2006. Now coming to the year end. Year end, when you come, you have to remeasure the provision. Now you see this is 1.008 to the power 9. 1 year went. After 1 year, every year it will keep reducing to the power 9, to the power 8, 7, 6, 5, like that. So this is the amount. Now, you see earlier you have recognized a provision. You need that figure this year. So that is the balance brought forward, the opening balance. Now, this is your closing balance. The difference is your borrowing cost. There is another way of finding this amount. Either you can find it as a balancing figure or you have to use this method. This is known as unwinding of the discount. You're finding the interest rate. So the amount that you have got earlier, on that you have to take 8% because 8% is the interest rate. Discount factor. That discount factor only you have to use to find the interest on the opening balance. So 8% into the opening balance. So when you add them together, you should be able to get this figure. It's the same as this. Now, how do you debit? It's an interest expense. Debit. Okay, I'm sorry. The first time you are recording it, it's not an interest. Interest is recorded from the second year onwards. First year, it is the provision only. First time when you recognize the provision, it will be debited in P&L. Okay, here. Now, when you come to the second year end, you have to debit this expense. It's an interest. And because of this, your provision value went up. So, credit provision. Whenever provision reduces, provision will be debit. Now, this is 37 December 2006. Now 37 December 2007. Again we are remeasuring. Now it will change to the power 8. So now value even increased. Again, now you will take 8% on this balance. And you will get it. So now debit, expense, interest and credit provision, this amount. Only the increasing amount you have to write in the P&L. As well as in the provision you have to debit or credit. Not the total amount, not this amount. Okay, how much it increased or decreased from last year to previous year, only that you will record, both in the provision and P&L as an expense. Now coming to reimbursement. Some or all of the cost of settling a provision may be reimbursed in the form of insurance payout, supply warranty or counterclaim. Now, if some or all of the cost of settling a provision is expected to be reimbursed by a third party, that reimbursement should be recognized only when it is virtually certain that you will be receiving it. This reimbursement will be recognized as an asset and corresponding item of income. Why? Because you are receiving it. So it's an asset for you. That reimbursement will be asset. Now, the expense that relates to the provision will be presented net of the amount recognized for reimbursement. That means whatever the amount you get, you will deduct the expense from that and show the net amount. Okay. Offset in the statement of profit and loss is permitted. See, almost all the standards does not allow you offset, but very few standards allow you offset. One of this is IAS 37, where they told you that you can offset in the statement of profit and loss the expense against the asset. Now, The reimbursement is treated as a separate asset. Offset is not permitted in the statement of financial position. It is only permitted in statement of profit and loss, not in statement of financial position. And it must not exceed the amount of the provision. The amount that you are getting when you are reimbursing, offsetting should not be more than the amount of provision. Now, how do you disclose provision? This has to be disclosed. First, carrying amount at the beginning and end of the period. Additional provision, amounts used, unused amounts reversed, increase in the discounted amount due to passage of time or change in rate, we have just seen it. A brief description of the nature of obligation and the expected timing of the expenditure. An indication of the nature of uncertainties about the amount or timing of the outflows. Amount of any expected reimbursement with details of asset recognition. You have to disclose all this. Now, in extremely rare case, disclosing some or all of the information required might seriously prejudice the entity's position in its negotiations with other parties. That means they are saying that it's not good to disclose in very extreme rare cases, because if you disclose them, it might harm the position, entity's position, when you come to negotiate with the other parties. So in this case, information should not be disclosed, but entity then should explain why they're not disclosing if they're not disclosing. So what should they explain? What is the general nature of the dispute and fact and the reason why that information is not disclosed. Coming to contingent liability. So that's it with provision, general provision. Now we are moving on to the contingent liability, the second part of IAS 37. Let's define contingent liability first. A contingent liability exists when the criteria to recognize a provision are not met. Why? Because a possible rather than a present obligation exists. That means there is no present obligation, but possible obligation is there. Obligation is there, possibility is there, but it is not present. If it's a present obligation, it would be provision. But if it's not present obligation and if it's a possible obligation, then contingent liability. Contingent liability is even more uncertain than provision. Or there is a present obligation, but the outflow is not probable or you cannot measure it reliably. Then contingent liability. So, a possible obligation which arises from past event whose existence will only be confirmed on the occurrence or non-occurrence of one or more uncertain future event. You will only know it in the future because it is not something within the entity's control. Or present obligation which arises from past event but it is not recognized because outflow is not probable, or you can't estimate the amount of obligation, which is very rare. Accounting treatment for contingent liability. Contingent liability we normally disclose. We do not measure like provision. So we disclose unless the possibility of outflow is very remote. In that case, we don't have to disclose. It's very remote. Disclosure. These are the disclosure. Estimated financial effect, uncertainties related to amount or timing of outflow, possibility of any reimbursement. There is one exception to the non-recognition of contingent liability. What is this? IFRS 3. In IFRS 3, it requires a subsidiary's contingent liabilities, which are present obligation, to be recognized. See, you might say that we do not recognize contingent liability, but in one case, you have to recognize the contingent liability. That is when you buy your subsidiary. Your subsidiary's contingent liability, you have to recognize and measure them at fair value. Okay, this detail we'll see in lecture 23 when we go to group accounting, because they are present obligations. So except that one, others you don't have to recognize, you only have to disclose. Now, coming to contingent asset. Contingent asset exists when an entity has an uncertain income. Contingent asset, possible asset, arise from past event. Existence will only be confirmed by occurrence, non-occurrence of one or more future uncertain event, not within entity's control. Same like contingent liability definition. In this case, you are receiving contingent liability, you have to pay. Contingent asset usually arise from some unplanned or some unexpected event that give rise to a flow of income. So, for example, pursuing a claim through a legal process. Now, contingent asset is even more strict compared to provision and contingent liability, because recognition or even disclosure of contingent asset is even more strict. Let's see how. Contingent asset we can't recognize because income may never be realized. But When the realization of income is virtually certain, related asset is not contingent. Then you have to recognize the provision. Recognize it. A contingent asset is therefore disclosed. Like contingent liability, we disclose contingent asset only when the flow of economic benefit is probable. Disclosure includes brief description of the nature of contingent asset and where predictable, the estimate of the financial effect. Now, so this is the summary. The following table will help you with the accounting treatment of provision, contingent asset and contingent liability, depending on the likelihood of the transfer of economic resource. If the likelihood is very remote, we do nothing for contingent liability, nor we do anything for contingent asset. If it's probable, probably not, we disclose contingent liability, but we do not disclose contingent asset. It's probable, we disclose the contingent liability. If you can make the reliable estimate also, we'll recognize the contingent liability. Otherwise, we'll disclose. Here, we'll just disclose. If it's virtually certain, we recognize contingent liability, we recognize asset, but they are not contingent. Okay, this table will help you. This is the summary of all what I have discussed till now. Now, contingent asset and contingent liability, you cannot recognize them in the statement of financial position. Contingent liability, you can recognize in the consolidated financial statement. In some specific circumstances, we'll see in lecture 23. Now, coming to the specific circumstances. So, we have finished provision, contingent asset, liability. First condition, future operating loss. We do not recognize provision for future operating loss. Why? Because they do not arise from past event and there is no obligation. You can even avoid it also. Let's say you are having a loss from your business. Shut down the business, you will not make the loss. So you can avoid it. Therefore, no obligation. So, an expectation that there will be a future loss is an indication that your assets may be impaired. You have to use your IAS 36 test. IAS 36 impairment of assets. Next condition, onerous contract. This is a contract in which the unavoidable cost of meeting the obligation under the contract is more than the benefit. That means under the contract, it's a loss-making contract. So the present obligation under the onerous contract is recognized as a provision. An example of an onerous contract that falls within the scope of IAS 37 is a loss-making contract with a customer, according to IFRS 15. Then you have to recognize a provision. Now, a provision will be recognized for the excess of the cost over the benefit. Okay, which is lower of this two? Cost of fulfilling. This includes all your incremental costs. See, this cost you have incurred because you are going ahead with the contract. Otherwise, you would have not incurred this cost. So, incremental cost and allocation of other cost, and any compensation or penalties arising from failure to fulfill it. Whichever of these two is lower, you will recognize a provision up to that amount. An onerous lease contract also falls within the scope of IAS 37 if the recognition exemptions are applied. Recognition exemption means we do not recognize them, or the lease has not yet commenced. See, what are the recognition exemption? You have to go to my previous lecture. Under IFRS 16, I have explained what is recognition exemption. Under two conditions, you can claim for this, where you will not recognize lease. One, low value lease. Second, when a lease is for short term, less than 12 months. So in that case, you can apply. If you apply for that, you will not record it as a lease. It will fall under IAS 37. So in all the other cases, no provision will be required because a lease liability has already been recognized. In all the other cases, you will not recognize a provision because you will recognize lease liability instead. For this part, better to watch my IFRS 16 video. That's my previous lecture 15. Now, example 9 of the onerous contract. So let's see this. ZY has entered into a contract with Gatsby to purchase 100,000 units of 50 per unit. Now, they have to pay a penalty of 15 if it did not purchase. Market price has fallen to 30. And ZY has decided to invoke the penalty clause rather than pay 50. It is still contracted to buy 74,000 units of gas. You have to calculate the provision. Okay. First, you have to understand what is the cost to fulfill the contract if they buy the gas. So they have the contract to buy 74,000 at 50 units. Okay. So they will go 74 into 50. That is 3.7. And they will sell it for what? Again 74,000 into 30. See there they told ZWA has decided to invoke the penalty clause rather than pay 50. That means they are going to sell it. If they do not purchase, they have to pay a penalty of 50. And market price of gas has fallen to 30. That is the amount that you will sell. So 74,000 into 30, which is 2.2. So you can net off 3.7 minus 2.2. This is the net cost 1.48 if they fulfill the contract. This is how you always have to do. You have to net off. Then if they do not fulfill the contract, what is the penalty that they have to pay? It's 15. So 74,000 into 15. Do not take 100,000 because they have the contract to buy 74,000 only. Okay. So 74 into 15, which is 1.11, whichever is lower. Okay. They will not earn any income because they have to pay penalty for not buying. So this is the cost. See here, what did you do? This is the cost and this is the amount that you will get. So you net it off. And net cost. Cost is more than the amount that you will get from selling. Here you don't have any income, only cost of penalty. So if you see the lower is this one, 1.1 rather than 1.48. So you will recognize a provision at 1.11. This is always for onerous contract. Now, coming to restructuring, the third case. And often in your exam, compared to the other areas, restructuring is the one which is normally asked. Right? Restructuring is a program which is planned and controlled by management and materially changes either scope of the business or manner in which business is conducted. Events. So examples of events that are classified as restructuring. First, when you sell or terminate a line of business, closure of business location in a region, relocation from one region to another, changes in management structure or eliminating a layer of management, fundamental reorganization which have a material effect on the nature and focus of the operation. Application of recognition criteria. So if your event falls in one of this category, they are restructured. Then you have to apply the recognition criteria. But if your event does not fall in any of the criteria given above, it is not a restructuring. Okay. So assuming it's a restructuring. Now you have to recognize a provision. Okay. A provision for a liability for restructuring is only recognized when there is a present obligation as a result of the past event. And this must be a constructive obligation. So it's not a legal obligation. You don't have any contract or law, but constructive obligation because in the past you used to do. So constructive obligation to restructure arises only when an entity has a detailed formal plan for the restructuring and valid expectation. You have discussed this issue with the ones who are going to be affected. For example, you told your employee that they are going to be laid out. You have a detailed formal plan for it and they know that they are going to be laid off. It is an example of restructuring. You have to recognize a provision. But on the other hand, if you do not have any formal plan, nor you told the parties who are going to get affected by your restructuring program, then you can't recognize a provision. Okay. So a detailed formal plan must identify the business or part of the business concerned, principal location affected, location function, approximate number of employees who will be compensated for terminating their services, expenditures that will be undertaken, and when the plan will be implemented. So in the exam, you have to see whether all these are given or not. If they are not given, there is no formal plan. Next, management decision to restructure will not give a constructive obligation because management can change their decision also. Just by verbally saying they want to restructure is not a constructive obligation. Okay. But if the entity has started to implement the restructuring plan, all this before the reporting date, by the way, okay, not after the reporting date. If they start to implement the restructuring plan, how? They started selling the assets or they have announced the main features of the plan to those affected that restructuring will occur. Then it's a constructive obligation. No obligation arises after the sale of an operation until there's a binding sales agreement. What does it mean? You can't say, see, there should be a binding sale agreement for you to say that there's going to be a sale of an operation. If there is no binding sale agreement, then there's no obligation for you to sell also. For you to have that obligation to sell, that means in short to restructure, there should be binding sale agreement. Now, measuring the restructuring provision. So they can provision for restructuring can include only those expenditures that are both necessarily incurred by restructuring. That means if restructuring did not go ahead, you would have not incurred this expenditure, and not associated with ongoing activity. They are those activities that are one-off, only incurred for restructuring. They are not normally ongoing activity. For example, you are paying your employee salary or wages. They are not restructuring activities. They are ongoing activity. Normally you will pay them. So you can't take them as expenditure for restructuring, therefore no provision for them. Okay. Restructuring provision cannot include the following. First, cost of relocating or retraining staff. Often they give this in the exam. And often students mistakenly recognize provision for this. That you should not do. Okay. Because you would have anyway relocate your staff even before provision. Or you might anyway retrain them for any other purpose also. It is not only for restructuring. That's why. Next, marketing cost. You would have anyway incurred the marketing cost. Cost of investment in new system or network. They are not restructuring provision. Operating loss up to the restructuring date. You can't recognize provision for this four. Now, let us see some questions. No announcement of board decision. Example 10. So on 12th December, the board had decided that they will close down a division before the reporting date, 31st December. Decision was not communicated to those affected. No other steps were taken to implement the decision also. So in this case, it's very clear cut. Present obligation, no, because they did not tell the relevant party. Outflow of resource, irrelevant because there is no present obligation. So conclusion, no provision. Very simple. Next, here the board has announced. So on 12th December, entity again decides to close down. This is same scenario, they have just changed some event. Now they have decided they will close down, and on 20th December, they have agreed a detailed plan and letters were sent to those who are going to get affected. Redundancy notices also were sent to the staff. Here, there is a present obligation. Okay, because you have communicated it to the customer and employees, that means this gives rise to a constructive obligation. Outflow of resource, probable. Therefore, you will recognize a provision at 31st December. Next event from restructuring was the third. This is the fourth event. Decommissioning and restoration cost. An entity may be committed to remove an asset or making right the land that it was or that it was on when the asset reaches the end of the useful life. That means when you use the asset or when you use the land for a specific time while you're constructing the asset, you are under a commitment that you are going to restore it back to its original condition. Okay, this type of cost are called decommissioning or restoration cost. This is very common in oil industry when an oil rig has to be dismantled at the end of its useful life and environment restored at natural condition. So decommissioning and restoration cost, they are very important in the sustainability issues. Okay, so IAS 37 says you have to recognize a provision when an entity has a present obligation to incur this cost. So provision could be set up on the initial recognition of the asset or the pathway through its life. Now, the provision for decommissioning cost will initially be recognized at the present value of the future expected cash outflow in respect of obligation. The double entry is to debit the asset. IAS 16 or IFRS 16. Why IAS 16 or IFRS 16? If it's a PPE, you are owning it, IAS 16. If it's a leased asset, IFRS 16. Depending on what asset it is. Credit, we all know, provision is credit. Okay. As the time passes, present value of the provision will increase. Now you have to discount. This is known as unwinding of the discount. See, any liability, you have to recognize the interest with it. So that interest expense you will get by getting the discount factor multiplied with the provision. That interest expense will go in the profit and loss. We have done this unwinding of discount before. Okay. Let us see one example. Example 12 about a decommissioning provision. So, entity purchased an asset. Entity is committed to dismantle the asset in 5 years' time. Cost is 12 million. They have satisfied the recognition criteria according to IAS 37. Appropriate discount factor is 7%. So, 5 years' time, 12 million, 7%. 1st Jan 2003. So, the initial measurement of provision on 1st of Jan 2003. So, since it's for 5 years and 7% discount with 12 million cost, so as I told you earlier, this is how you are going to discount. It's 1 plus 0.07 because 7%. You have to bring it to decimal and to the power 5 because in 5 years time and multiply with the cost. So this is the amount. So you debit your asset by this amount and credit provision. Coming to 31st December 2003. Now we are remeasuring the provision. Now this 5 will become 4. Everything else remains the same. You see your cost increase from 8.5 million to 9.1 million. So we'll bring the brought forward balance from 1st Jan, and this is called unwinding the discount. So on this you will charge 7% because 7% is the discount factor which you have to use to find the interest rate, and you will add it, and this is the carried forward balance. This balance you see, it is this exactly the same balance. So now in your profit and loss there will be an expense which is 598,908 and credit the provision by that amount. Only the increment amount you have to write. So from the previous figure to this figure, how much provision increase? It is only 598,908. You are not going to write the this amount 9.1 billion. Okay. Then in the asset, because there is an asset that has been recognized, you have to depreciate it. So how are you going to find the depreciation expense? You have to go here 8.5 million, this opening balance, and divide by 5. So that is the depreciation and credit accumulated depreciation. The total expense will be the interest expense and the depreciation. So this 2.3 million. Okay, this is very simple. Now coming to the next. This is the 5th issue. Self-insurance. The cost of insurance have been prohibited for many businesses. Instead, they choose to self-insure rather than take out insurance policy against the various risks that they face. Rather than pay insurance premium, what do? How do they self-insure? They set aside some cash fund to meet future expenses associated with uninsured risk. So nothing prevents an entity from ring-fencing cash to meet any future uninsured cost. There is no obligation that they have to do this. They might save, they might not save. Therefore, IAS 37 says you can't recognize a provision for self-insurance. Okay? And self-insurance is a future operating cost that will only be recognized when actual expenses incurred. So you can't recognize a provision. If accounting for self-insurance by setting up a provision were permitted, profits could be manipulated. That's why they don't do this. Now, next, repairs and refurbishment, the 6th. And this is the last. That is, first let us go to IAS 16. Okay, so IAS 16 says that some assets need routine maintenance. Okay, after every few years. For example, engine of the aircraft or ship, they need a substantial expenditure every few years. So this cost you should not give provision for this type of cost. Instead, IAS 16 applies. If any repairs and refurbishment is done for assets, they will be accounted under IAS 16, not IAS 37. So no provision. So you can see my lecture 7 where I've discussed IAS 16. Now example 13. No present obligation, no provision. Let's see this. So the scenario is a furnace lining needs to be replaced every 5 years. At the reporting date, they have been used for 3 years. Now, this is the answer. So this cost of lining will not be recognized because at the reporting date, there is no obligation to replace the lining. Even the intention to incur the expenditure will depend on the company deciding to continue operating the furnace. There is not obligation. So instead of the provision, what do? You depreciate. The lining you have to depreciate for 3 years because you have consumed it for 3 years. And about relining, cost will be capitalized. This is according to IAS 16. So consumption of any new lining will be recognized through provision over the subsequent 5 years. Not provision but depreciation. Now, when there is no legal requirement. Okay, one example of reformation cost is you have to do it but no legal requirement. Next, legal requirement is there. For example, an airline is required by law to overhaul its aircraft every 3 years. So in this case, still will not recognize a provision for the overhauling for the same reason that was there for furnishing lining. So we do not recognize provision. Even though there's a legal requirement to overhaul, does not make overhaul a liability because no obligation exists to overhaul the aircraft independently of the entity's future actions. So airline can avoid also this future expenditure. How? By selling the aircraft. So it's not an obligation. Instead of provision, again you do what do? You recognize depreciation. So the amount that is equivalent to the expected maintenance cost, you will capitalize it as an asset according to IAS 16 and will depreciate over 3 years. Same like the furnace example. So that's it for this lecture. So from our syllabus, we are still in section B, going for the 7th element, that is provision. So here we have explained why an accounting standard on provision is necessary so that we can avoid manipulating profit, right? Profit smoothing and all we have seen in the beginning of this lecture, right? Next, differentiate between legal and constructive obligation. Legal is by law, by contract. Constructive is something based on past practices. Then state when provisions may and may not be made and demonstrate how they have to be accounted for. Explain how provisions should be measured. So there are two ways. Best estimate way, most possible outcome, and you go by the probability. Define contingent asset and contingent liability and their disclosure. Then you have to identify and account for specific issues, warranties and guarantees, onerous contract, environmental decommissioning, similar provision, restructuring. That's it. Now, let us summarize the lecture. An entity must recognize a provision if and only if present obligation is there because of past event, payable is probable, and account can be measured reliably. Three things has to be there. An obligating event creates legal or constructive obligation. That means you have to settle the obligation. There is no other way. Constructive obligation, it results because of your past practice. Provision is measured at the best estimate of the expenditure required. If it's a one-off event, most likely outcome. If it's a repeated event, expected value. For example, throwing a dice is a repeated event. You have to use expected value. One-off event, most likely outcome. We have done questions on both of this. Then, provision has to be discounted if time value of money is material. They will let you know in the question. If the time value of money is immaterial, no need to discount. If it's material, you have to discount. Most of the time, you have to discount. Okay, the discount factor that you use to find the present value will be the same discount factor you need to find the interest expense. That is known as unwinding the discount. Every year and you have to do that. And we have done question on that. Then provision is recognized as a liability with corresponding entry to an expense or an asset. That means debit, your expense or asset will be debited. Provision is liability, so it's credited. Provision can only be used for the purpose for which it was recognized. If it is no longer probable that outflow of resource will be required, you have to reverse the provision that you have earlier recognized. Reimbursement relating to provision is recognized only if it's virtually certain that you're going to receive the reimbursement. In the question itself, they will let you know whether it's virtually certain or not. Then, contingent liability is a possible obligation or a present obligation but does not meet the recognition criteria of provision. Contingent liability are not recognized but you disclose unless it's removed. If it's removed, you don't disclose. Contingent asset you can't recognize, you only disclose when it's probable. Future operating loss, self-insurance, repairs, you can't recognize a provision for this three. For onerous contract, you can recognize a provision at the least net cost of exiting the contract. That means you see the lower of your penalty versus your net cost of fulfilling the contract. Then for restructuring can include sale, termination or closing or reorganization. For example, you're selling the operation. But when you're selling the operation, there has to be a binding agreement. Closure or reorganization, you have to announce the plan. If there is any necessary expenditure, you can say direct cost of restructuring, there is a restructuring, but not ongoing activity. Decommissioning, restoration, are also recognized as part of the cost of asset to which they relate. So that's it. There is one technical article that you have to read, that is IAS 37 Provision, Contingent Liability and Contingent Asset. You can go to your ACCA website and make sure that you read this article. Thank you for watching, and I shall see you in the next lecture. And make sure that you do questions on IAS 37 from your revision kit. There are plenty of questions on IAS 37. And by the way, my revision kit will be coming soon after finish all the lectures of FR. Thank you for watching.